Howdy, Jacob here. Today we're looking at Napco Security Technologies, company 86 of our high ROIC screener. 1.4 billion market cap on a little bit less enterprise value in the electronic equipment instruments and components industry. They develop, manufacture, and sell electronic security products in the US and internationally. Return on invested capital, you can see, has been growing very consistently since early to mid 2000s, late 2000, maybe 2010 or so, to where they are now producing return on invested capital of 20%. Gross margin has increased 12% over the last 9 years, with earnings on the operating margin side over 12% increase. Very impressive increases there. Balance sheet shows about 77 million in very liquid assets with 26 million total liabilities. So no concern on the balance sheet. Very sexy balance sheet. Balance sheets aren't incorporated in our free cash flow and earnings calculation, but are used for margin of safety if you want. And sometimes they're incorporated into, if enterprise value is that much less than or that much greater, I might tweak my P and price free cash flow to be based on enterprise value and not necessarily market capitalization. A little bit increase on reinvestment. Looks like recently 25, 26 million. Use of cash otherwise. They've just started paying a dividend. But other than that, just increase in their cash on their balance sheet. So interestingly enough, it's going to be tough to really make some assumptions on what they do with free cash flow. We're just going to have to use the history that we have to base our assumptions on growth and everything else with that. So let's start making some assumptions. The growth of the company has been pretty substantial, and they're still a very small company. So I think that I wouldn't be surprised if they were to be able to grow at 10% over the next 10 years. And by then, they would still be a fairly small company to where they'd still probably have a good amount of growth ahead of them. I don't know this industry entirely well, but I presume that it is bigger than, what is that producing? Maybe $400 million. I assume it's bigger than that. So obviously, when you do more research on the company, you'll see what that is in relation to their market. But for now, I think I'm reasonable. I think those assumptions are reasonable. As for margins, they've been increasing pretty consistently. So maybe let's do 14 and 13% with no revenue or no share change due to the fact that stock-based compensation is relatively low, and although they haven't repurchased shares in the near-term history, they have repurchased them in their last 10 years or so. So I think I'm comfortable with the assumptions. I think that right now it just looks a bit expensive for me. Not uncommon in the market we're in and the companies I'm looking at. High ROIC companies are likely going to be selling at premiums. So if you can get a high ROIC company with great revenue ahead of it, I might be downplaying some of these valuations, but to me, that these are the valuations that make the most sense. And so I understand if your perspective is different. This is just my perspective and where I'm at in my assumption setting history. But for now, yeah, like I said, just a little bit expensive, and I'll wait to do more research on it. Hopefully you enjoy the video. Have a great rest of your day. Thank you.